Welcome, everyone. We're super happy to have you guys joining us. I'm Chase Austin with the Technology Licensing Office and Utah Venture Hub, and welcome to this first webinar, a part of our U Startup Launchpad series. This first session is a super important, critical topic all about equity and startups. It's a common area where you can make mistakes early on that are hard to repair later. So it's really helpful information. We're joined by Ryan Udell, who is a partner at Ballard Spahr and co-leader of their life sciences team. Ryan also teaches a venture capital course at Lehigh University, so we're super happy to have him, and he's a wealth of knowledge. So without further ado, I'll kick it off to Ryan to lead this session.
Excellent. Thank you, Chase. And happy to be here today. I am, as Chase mentioned, I'm a partner at a national law firm, Ballard Spahr. We have a office in Salt Lake. And while I do not reside in Salt Lake, I wish I did. I reside, unfortunately, in the East Coast now where it's over 100 degrees. So we're trying to keep cool. But I'm out in Salt Lake at least 5 or 6 times a year, and we're super supportive of the startup community in the Salt Lake area. And it's a really, really burgeoning and dynamic market. So those of you that are participating, wherever you're from, I'm happy to have you. As Chase mentioned, we're going to talk about the topic there, which is understanding equity, cap tables, and dilution. And I'll just move to the next slide. Just before I get started, this is a little bit about our firm. We're over 750 lawyers. We're in 18 offices, as I said, also in Salt Lake City. We've been there for going on 20 or so years now. We have we're a full service firm. We do everything from soup to nuts pretty much. But in this particular case, we do a lot of ECVC work, which is important to this topic. ECVC is emerging company venture capital, for those that are not in the know. Okay, so in order to understand equity and building your cap table and not engaging any mistakes that are hard to repair, we first need to talk a little bit about the entity that you might use for your startup. And I'm going to go through that. I'm not going to go through every single degree of why you should choose one over the other. There are a whole bunch in the slides, which we will make available after the meeting. However, the two that I'm going to focus on are the two most common vehicles that are used when you start up a company. One would be a limited liability company. The second would be a corporation. So without further ado, let's kind of talk about it for a minute. So key considerations, for entity selection. One and two are really the really important ones. For someone that's starting a business, you get limited liability. Most for an entity of the two that we're talking about, which are limited liability companies and corporations. There are also different tax attributes. A lot of that's beyond the scope of this conversation. However, essentially, there are two types of tax pass-through, meaning that the entity is essentially disregarded for tax purposes. It flows through to your own personal returns. The other is that the entity has its own tax filings, pays taxes, and then there's distributions out to the shareholders. That's a C corporation. The first one is a limited liability company. It could also be what's called an S corporation. But effectively, those are the two main differences from the tax perspective. Some entities limit the number of owners you can have and the types of owners you can have. That's like an S corporation limits the types of owners. So typically, if you're raising outside capital from institutions, you don't use an S corporation. You would use most likely a C corporation, and sometimes in the early stage, you would use a limited liability company. Move on to the next slide. This is just, again, some of this is not really relevant. We're going to focus on the C corporation and the limited liability company in terms of conducting your business. Where do you organize? Where you organize is interesting. The the concept of organization really really doesn't make that much of a difference when you are on your own and say you had a bootstrapped company or you had a family business. You typically, the old way of doing it was organizing in the jurisdiction in which you formed it. However, for those that are for those that are seeking outside capital, particularly when you get to institutional capital venture funds, they require that you be formed or re-domicile, as it's called, change jurisdictions to Delaware. And the reason why that is, there's a lot of reasons, but high level, the reasons why those are is because not because taxes are less. That's a fallacy. It's because Delaware has the most well-developed courts. They're generally favorable to investors, and they have the most well-developed courts on all kinds of matters where there might be an issue or there's a dispute between whether it's the founders and the investors. Delaware has seen that and has had a pronouncement about it. So that's why you use Delaware as the preferred jurisdiction for where you formed. So this is another chart, this entity selection, which just shows who does what. And again, I think for our purposes, we're focusing on the C corporation and typically either of those LLCs at the end. This just talks about the basic corporate governance. For a C corp. You'll have your stockholders who elect the board, who appoint the officers, who run the company on a day-to-day basis. In a manager-managed LLC, it's very similar. The managers are, in essence, the board of directors, and the managers then appoint officers who then run the day-to-day business. So entity selection, again, this is also just showing, okay, so for our purposes in terms of equity, if you look at, you have the owners, who they are. So C corporation stockholders, manager-managed members are similar to stockholders in the LLC. And then how it's owned. In corporation, they're shares. And in an LLC, their membership interests or units, which are similar to shares, just called something a little bit different. And the documentation that you will have as you go along is you start a corporation by an articles of corporation, and you have bylaws. Bylaws govern the operation of the business at a governance level. And then in an LLC, you have the articles of organization and you have an operating agreement. Okay, so we'll move to where incorporate already. So most people will incorporate in Delaware if they're looking to raise outside capital for the reasons I already discussed. Okay. Now, the other point that I wanted to raise in addition to tax is that you set up your entity as a limited liability entity that protects the stockholders from having personal liability, stockholders or members in case of a limited liability company, from having personal liability for the operation of the business, which you wouldn't want. And so, depending, if you're in a life sciences business and you are developing a new molecule, you're developing, a new gene therapy treatment, for example, and it gets out in the market and you're now selling that, you obviously wouldn't, if something went wrong, God forbid, you wouldn't want to be personally liable. So you have a limited liability vehicle that allows you to operate separate apart from you individually. There are some basic blocking and tackling that you have to do in order to achieve that limited liability. Things such as applying for a separate EIN and making tax filings, having minutes, keeping corporate formalities or entity formalities, having a separate bank account. Things that you probably think are basic, but you just need to make sure you follow them, because if you don't follow them, if you, for example, commingle your personal bank account with your entity bank account, and those funds are moving back and forth, then someone would say, if anything ever went wrong and there was a claim against the company, they may say, you treat it as one and the same, and we're going to make a claim against you individually. So it's real important to follow those basic formalities. Okay. Next slide. Okay, so now we're going to get into some equity components of entity selection. when you give out equity, and we're going to talk about giving out equity in more detail in a minute, but just in general, when you give out equity, there's a number of ways you can do it. I'm going to talk about it in the context of a corporation. So with a corporation, you could give out shares, you could give out options, you could give out warrants. Warrants and options are very similar, but those two latter types of securities are not actual equity. They are the right to either acquire equity or receive equity upon certain situations. When you give out equity that has some value, that generally speaking, so if I have, I start up ABC company, and I'm hiring my first employee, I don't have a lot of cash, so I have to provide that employee with some equity. I make a grant. That grant is taxable as compensation to that employee. And so in the beginning, when the company is not worth a lot, there is a way of structuring it so that you pay tax on that equity at extremely low value, and then let's just say I give out equity subject to certain vesting requirements. Then that person doesn't pay tax on the increase in value. They paid tax on the initial value, and it grows tax deferred until they sell it. And in order to do that, you have to make certain tax filings. One of them is what's listed on the screen, an 83B election. Beyond the scope in general, but it's important that you make that filing within 30 days of grant. If you don't, it can become problematic. And I'll give an example. So we represented a startup, and the startup, we represented a startup in the sale of its company, like sort of the nice result. It was a good sale. However, the startup in its earlier stages had given out a bunch of equity, did not have good record keeping, not good corporate hygiene. And we had to spend an awful lot of time fixing what could have been done with a few filings, and it took a lot more time and effort and expense to fix it so that there wouldn't be a big tax problem. Secondly, when you give out equity, like as compensation, especially if there's some value, whether it's options or whether it's grants, you should get a 409A valuation. What that is simply you can get it through Carta. Those of you who are familiar with Carta, Carta is a cap table management tool. What it does is gives you a safe harbor, absent any material changes, to issue equity at the price that at the value that Carta provides the value, the 409A value. And if you do that, then you don't have a tax problem later. I recognize that in early stage companies where they don't have spare cash laying around, that it typically doesn't happen until there's some level of investment, whether it's some angel investment or a venture investment. But certainly as you move down the pathway, in the life cycle of your company, that you really strongly consider having a 409A valuation when you issue additional options or other equity grants. And really, when you get to that level, you'll have a board, you'll have outside investors on your board, and they will require it. Okay. The last thing just to be aware of is that one of the reasons why investors like C corporations is because there's the most certainty on that, and particularly in Delaware. The other reason is that there's a significant tax benefit for investors that invest in corporations as opposed to LLCs or others. And it's called qualified small business stock. Actually, this is in the process of potentially being modified in the current tax legislation that's still being, negotiated in Congress. But generally speaking, it allows an investor to get 10 times its investable amount tax-free of federal tax purposes. There's a bunch of requirements that you have to satisfy that are probably beyond the scope of this discussion. However, just be aware that that's one of the reasons why investors will require you to be a corporation. There are others, but this is one of them. Okay. All right. Next topic, capital formation. So we got the basics. We're we're making our decision between an LLC and a corporation, and now we're going to talk about raising capital. So first of all, I think we talked about some of these things already, but a C corporation, we have to set it up so that initially, let's say your friends and family or even some angels will invest in what's called common stock. But a venture investor and some other angels down the line will prefer to, no pun intended, invest in preferred stock. So what's the difference? Now, common stock is a kind of stock that comes with it under the law, whether it's Utah corporations, Delaware, it doesn't really matter. Voting rights and the rights to essentially participate in the upside of the value of the business. Those are the two basic rights that common shareholders have. So they vote on matters, and they have the right to participate in upside. Common stock. Preferred stock is is really a creature of the venture capital industry. Prior to about 30 or so years ago, 30, 40 years ago, preferred stock was really just a sleepy kind of security that was given in stocks that are more value stocks like utilities and things. And it was used as essentially almost like quasi debt. It was straight preferred, meaning I invested in that company. Let's say I invested $100,000 and I got a dividend, and that dividend was fixed to that security. And then when I sold it, I would get my $100,000 back and I would keep all the dividends. Convertible preferred stock, which is really what is used today in most angel later stage seed investments and then also in Series A and beyond. Convertible preferred stock means that I get the benefit of that preference of what I invested, which was the $100,000, but I can convert it into common and then participate in the upside. And I convert into common at a preordained price that will be in the documents. So initially, let's say that the shares are $1 a share. I can convert 100,000 shares of preferred into 100,000 shares of common. And when we sell, so along the way, I get my dividends that we talked about, and then I can convert that into common, and we sell for a big number, and I participate in that as well. And I'll show you that the impact of how this works when we get to the cap tables. But suffice it to say, it's essentially the best of two worlds. One is that I get my money back first. Two is I get to participate in the upside. There are other things like that capital are used for. Issuance of common stock. You can issue it to yourself as the founder, to employees, advisors, and consultants. And what Chase mentioned early on is some of the biggest pitfalls are at this early stage. This stage before you raise any money from outsiders or anybody beyond your friends and family. Because everybody's very excited about their, if it's an invention or it's a business idea, it really doesn't matter. You're excited. You don't have a lot of capital, and you have a partner, or you need some people, whether it's a consultant, an advisor, or others, to perform services for you. So what's your currency? Well, your currency is your stock. And a lot of folks are quick to give out stock without restrictions on it or without milestones. And what happens then is you're in business with someone, you think things are going great, you gave them 25% of the company, and they didn't do what they said they were going to do, or they lost interest, and now they have 25% of the company, and you can't get it back that easily. So the piece of advice is, at the beginning, is certainly you got to do what you got to do to get your business off the ground, but you really have to think carefully about how you structure who you're in business with and how you structure the equity or the options that you give to that person. because it really can hurt you in raising capital later, and I'll get to that, or even on exit. Uh, one thing on exit is pretty clear is that you gave out 25% to someone, and let's just say, assuming you have 75%, and they have 25%, they have done nothing for the business. You put in all the sweat equity, and they get 25% when it's sold. Obviously, that's not a great result for you. It's a great result for them, but not for you. So you can see, like, that's kind of the easiest, starkest example. It gets even more complicated because investors don't like large chunks of equity going to folks that have nothing to do with the business. The other thing typically we do is, and it may depend on where you are in your life cycle, but at some point in your life cycle, you'll reserve some shares for a equity incentive plan. I talked a little bit about grants under that plan, like so equity grants to employees and other service providers. They can be straight up grants, they can be options, but you would reserve typically, the typical startup is a 10% reserve to give to key folks to help you grow the business. These other things that you'll see on the screen, these other documents, are a little bit beyond the scope of this conversation today, but there are agreements that you typically try to get with your founders to make sure that, for example, if you have IP that's been generated, that the IP stays in the company, can't be used outside the company. And then also you might have a stockholders agreement, or if it's an LLC, an operating agreement that deals with governance or restrictions on selling shares, the equity that person has received or that you've received to third parties, things of that nature. And that really gets readjusted when you have outside investors. And again, I'll get into that a little bit as we move on. The board of directors in an initial startup where you don't have outside investors, or typically it's typically pretty informal, and it could just be let's say it's two founders, it'd be just two founders on the board. It's one founder, it'd be one founder on one person on the board. Typically, documentation and those meetings and everything is much less defined until you stand up a more sophisticated set of board members, and that typically happens when at least you have angel investors that come in maybe later stage seed or in the A round. Okay. Okay, so I've alluded to different kinds of investors, and this just is a whole laundry list of folks that where capital comes from. It could be self-funded bootstrapping, right? You have your own money, you put all your own money at risk, and you do it yourself. Friends and family are, the easiest way a lot of times to raise money initially. If your friends and family have those means, you go to them, they put in money, it's less formal as well. Usually it's smaller amounts. But nevertheless, that's also a good angle in the early stage of your business. And then you move through angels, angels and super angels. Angels are, typically a little bit big, high net worth people for the most part, a little bit bigger checks. And super angels are typically angel groups that will pull together and make an investment. Micro VCs are just like they sound. They're venture capital firms that typically focus on the really early stage and make smaller investments. Family offices they can vary wildly, but the general definition of a family office is, a family that has a fair amount of money, whether it's through a family business or whether they've exited, and they invest in startups and other things. And so they're also a source of capital. SPVs and fundless funds are essentially similar to angel groups, although they typically come in a little bit later in the ball game, and that capital is raised on an ad hoc basis to make an investment in your company. And then venture funds are the the standard as once you get past proof of concept and into your A round and beyond, you would go through venture capital, and those investments could range from small all the way up to several $100 million for unicorns. And even like in the life sciences world, it's not uncommon now to have A rounds of 100 million or more, and that's because venture funds typically like to invest in de-risked assets, which de-risked assets could be based on the technology, but a lot of times it's based off of a management team that they've invested in before, who then they go and together select a technology to develop and then commercialize. Okay. And then the last one on the list is strategic and corporate venture. Those are if your business is in a particular industry, lots of big companies have either through their company or through separate vehicles venture capital available, and it's a different avenue. The one thing I'll say about those folks is, number one, it's great if you have them on your cap table, because if they have a particular area of expertise, they lend some credibility. The downside is a lot of the times they're looking to acquire your technology, and how they do that depends on the particular situation, but it could limit your upside value because they're investing in you today as a bet so that they have a first shot at the technology. If it works out, they want to buy it. Okay. Okay. Then we'll talk about a couple of different kinds of investments. These are the typical securities that you'll see. You may have seen these before, but quickly: convertible notes, safe, common, preferred, and then non-dilutive. So non-dilutive, I'll start there, is typically grants, whether they're NSF grants or SBIR grants or the similar, they're state analogs to all that. Anything that allows you to take in capital to advance your technology without having to give up equity is a non-dilutive financing. Okay. So convertible notes, just a quick one on this. Convertible notes are a promissory note that has essentially they're a surrogate for equity when you can't agree on value, and they're typically used at the earlier stage of the business. And the reason why they're used is number one, or the reasons I should say why they're used are, number one, you defer value. So if you think your company is worth X because it's like your house, you think your house is worth a lot more than your neighbor's house, you're never going to agree on that. So what you do is, instead of agreeing on it today and spending a lot of time and effort trying to come up with a number, you take in money, which defers that discussion on value till a next round. And typically, the typical features of a convertible note is it's going to have a discount to the next round. So meaning that if the value that you get your A round in, for example, is 10 million, and there's a 25% discount, the note gets to convert at 7.5 million. And there's also a cap, and cap is there to protect the investor, such that if the business catches lightning in a bottle and the next round is invested in at 100 million, well, the $100,000 that the convertible note holder put into your business it's going to be a very small piece of the business. So you typically negotiate a cap at which you convert. Other things that carries interest, the interest is typically 6 to 12 months, and the maturity is typically 18 to 36 months. The reason why there's interest is a tax reason, because you would not, like the IRS says, I wouldn't lend money to someone else that's not my relative for free. So if you don't charge an interest rate, there's an imputed rate. Secondly, on the maturity, that's because a loan has to have a maturity of some sort, and so you have to fix a maturity period. As a practical matter, and we'll talk about this with safes as well, as a practical matter, everybody goes into a convertible note investment understanding that If you get to the end of the term and you haven't had another round or you haven't had an exit, there's no way to pay it back, right? So this is really a vehicle to defer value. It's a loan, but it's not a loan that ever really anybody really thinks will be paid back. Okay. So that's convertible notes. Those notes, by the way, will convert typically into preferred securities, which we talked about briefly, and I'll talk about a little bit in a second. And that's why when we say the next round, that round typically is done as a preferred instrument as opposed to common because it's an outside investor. All right. Safes are similar to notes, except that they've dispensed with the artifice of using a note in order to defer value. And it's really just a contract that says that you will give me this money today and I will get equity in the future. So it's just a contract right. But it otherwise has similar features. Typically, typically safes don't have both discounts and caps. They have one or the other. Once in a while they have both, but typically they have one. The convention is one or the other. And the other thing that I'll just say is there's no interest on them, so you don't have to deal with that. And there's no maturity. Okay. So they're easy. Also one other thing, they're used more on the West Coast and in the Mountain West than they are in the East. Although, I think things in the venture world start west and they roll east, sort of like the weather. And so now they become more common in the East, but there's still certain groups that won't use them. They'll only use notes beyond the scope for why they prefer one or the other. But suffice it to say, if you're dealing with an East Coast angel group, they might insist on notes more so than a West Coast angel group. Okay. All right. So common stock and preferred. I talked about this a little bit. The common stock is that stock that has the right to participate in the upside. It's the simplest way of operating the business. And they also have the right to vote on who sits on the board and other matters that are material transactions, like a sale of the business. Preferred stock, again, we talked about, they typically have a preference, meaning they get paid first for dividends, distributions, and liquidation. Excuse me. There are two kinds of preferred that I didn't get into this. There's two kinds of convertible preferred, participating and non-participating. Participating preferred means that I get my money back. So I invested the $100,000 I talked about. I get that $100,000, and I also then get to convert into common and participate in the upside. Non-participating is a little bit of a misnomer. They do participate in the upside, but they have to choose whether they get their money back or they participate. So in that latter scenario, the non-participating, they would not convert if the investment didn't work out too well and they were just worried about getting their money back or a portion of their money back, because when there was an exit in a liquidation, they would get paid first. Okay. A couple other things that I think are important, and then we'll get into the cap table in a few minutes here, is the investment amount, right, is what you get in the investment. So again, going back to the $100,000 investment that I made in your company, if you had, I'll call it $1 million since it'll be an A round. So since I invested in $1 million in the A round, you may have had other convertible notes. You may have had a $100,000 convertible note. You may have had a safe. Those, when we did the A round and I made my investment, those typically would also convert into that round. And so now we have just preferred and we have common. And we've gotten rid of all the interim steps. The value's been set. Everybody is on a level playing field. Sometimes in an investment, there'll be more than one investor in that same round. And so that if it was me and two other venture funds and we're all investing, then we each put $1 million. We each, the investment amount aggregate is $3 million, but each one has $1 million. Okay. And then the price per share is basically just the pre-money value divided by the number of shares outstanding. So if, going back to my example, if we have $1 million that I'm investing and we have 100,000 shares outstanding, the price per share is, if the pre-money value is $5 million and I'm investing $1 million, and you have 100,000 shares outstanding, then the pre-money, or the price per share, shared, is $50,000 a share. Okay, so I'll show you this in the cap table to make it easier. Okay, and then sometimes, again, getting into what pre-money means, what shares are counted or options counted. So typically, and you'll see this again in the cap table, a venture investor will require the existing shareholders to take the dilution on the option pool. And what I mean by that is, let's say you didn't have an option pool, you'd have to put one in place, and that would be included in the pre-money shares outstanding so that the per share price is less. Since the per share price is less, the venture investor gets more. Okay. A couple other things to just note when we get into that we talked about, the dividend preference and the liquidation preference. These go to the preferred stock. And again, for the dividend preference, it's that interest rate. Essentially, it's like an interest rate. If it's 8% and it's a cumulative dividend, then that acts as interest. It's as if there's 8% accruing. Again, going back to my $1 million investment, 8% accruing on an annual basis. So each year, I add 8% to that $1 million. And if in 2 years, I then convert, I can either get paid out my interest, or I can convert that into additional common when we convert to common. Liquidation preference is what I said before. It's as non-participating or participating. It's what the preferred gets paid first before the common. So if it's, if I put in $1 million and it's non-participating, I decide, let's say we sell the business for something that doesn't make sense for me to convert, I get my $1 million back before the common shareholders get anything. You can play with liquidation preferences. They can be more than 1x. Typically in a Series A, they're 1x. Sometimes down the line, as you invest, as you take on additional capital, if you get closer to an exit, an investor may demand higher liquidation preferences to protect the investment, meaning that they may not get enough on a conversion because the valuation at which they're investing is so high. But generally speaking, it would be 1x. Okay. And the one other piece that I want to explain here for you all is anti-dilution rights. So when you take on venture investments, and a lot of times even an angel investment, they'll negotiate what's called anti-dilution rights. Anti-dilution rights just mean that it's a downside protection for the investor, so that if the investor invests at a valuation of 10 million and we're moving along, but maybe we have to make a pivot or things aren't going as we had anticipated, we need more capital, and we now have to raise money at 5 million, the investor's shares, the number of shares that person has, gets adjusted. And it gets adjusted such that if we raise at 5 million and they invested at 10 million, now they have the number of shares, they get adjusted at 5 million. There's two ways to do it. One is it doesn't matter what size the initial raise was versus the subsequent raise. All of their shares get adjusted to the lower price. The other, and that's called full ratchet. The other way of doing it is what's called weighted average, and weighted average takes into account not only the reduction in valuation of the business at the subsequent round, but also the relative size of the investment. So weighted average is much fairer to the existing investors. then to the founders than full ratchet, because full ratchet can be pretty punitive. Okay. All right. Now we're going to go through a cap table with the rest of the time we have. I just show here on the screen. These are just the various stages of a startup evolution from pre-seed all the way to exit. Pre-seed is just validation of concept. Seed's development. Early stage, is typically A and B, and the funding comes from super angels, micro VCs, and the like. And then later stage are bigger checks later, more developed company, expansion stage, sometimes it's called. And then the exit stage is whether it's an acquisition, whether it's a public offering, or an exclusive license of technology. That's your exit. And then that's typically where at least the investors realize, and sometimes the founders do, depending on the type of exit. Okay, so let's talk about a cap table here quickly. And so here's a basic cap table, and we have Larry, Moe, and Curly from the Three Stooges, those that know what that is. But Larry, Moe, and Curly, the assumed value here is $450,000, and they each have 1 million shares, and Larry and Moe have 22% each. I'm sorry, Larry and Curly have 22% each. Moe has 56%. Total is 100. Larry and Curly have 1 million. Moe has 2.5 million shares. Okay. Then, things are going well, and Larry, Moe, and Curly need to raise money, so they have an angel investor who's going to put in $500,000 for 10% post money, and that's at $1 a share. And so now, after the investment, you see what happens. Like, dilution by actual ownership is different than dilution of economics. So by actual ownership, now we have Larry, Moe, and Curly, and Larry has 20%, Curly has 20%, and Moe has 50%. So if we go back up, do you see what the dilution was by actual numbers? So 22%, 2%, and 6%. Okay. So then the angel investor invests $500,000 at the pre-money for 10% of the company, so the angel has 10%. Then we have a venture investment. So this is, take the angel. Now we're doing well. We got proof of concept. We're going to commercialize. And so now the venture fund is going to put in $6 million for 20% at $4 a share. Larry, Moe, and Curly have 13 and a third, 13 and a third, and 33 and a third, respectively. The angel gets diluted to 6.67, and the venture fund has 33% of the business. And then the post-money valuation is now 30 million. So again, difference between economic dilution and ownership dilution. There is no economic dilution because here in the evolution, we've gone up in value pre-money and post-money each time. Okay. And then we added in a private equity fund on top of this. Private equity fund is investing $7.5 million for 25%. And you'll see there, again, the effect of the additional investment. It doesn't have to be a PE fund. It could be another venture fund. Sometimes, we just use PE fund here just because, just to mix it up. But it could be the same thing. And you see there that at the valuation of 40 million, right? And then we go back to so valuation has gone up a little bit, and at 40 million, there everybody has their percentages 10.53, 10.53, 26. The angel has gotten is down to 5.26. The venture fund's down to 26.32, and the PE fund has 21.5. All right, and then at the exit stage, here's kind of where everything goes. The acquisition is 150 million, right? We're selling it for. Everybody's happy. The costs are 3% whether you include those or not, but just say the costs are 3%. So there's 145.5 million of net proceeds. The venture fund gets 28 million, right? And the PE fund gets 20 million, and you see what their rates of returns are. The proceeds, Larry, Mo, and Curly, that's what they get. So out of the 150 million, each of them are down to roughly 10%, and you get around 15%. I'm sorry, 15 million of the company, and Mo gets 38.3 million. So when you layer on things, this is all a good result, as opposed to where you have a down round, which I talked about, that anti-dilution. If you imagine if things didn't go as well and we had to raise money at a value that was less than the prior round, then the venture investor would have asked for what's called the anti-dilution protection. And if they got that anti-dilution protection, which is standard, Larry, Mo, and Curly's interest would have gone down precipitously. Okay. So key issues, right? In equity issuance, these are things that can come back to bite a company either really at any stage of the game, but if there's investment along the way, it could come up then. If there's bootstrapping and you got lucky and you didn't need to raise a lot of capital, it could come up at an exit. Some of that I've already talked about. But for example, not getting board approval and not having proper documentation for issuances of equity. Delays in issuance of equity that could cause tax problems for the recipient, particularly for compensation-related issuances. The 409A issue I talked about already. And then unwieldy cap table. Okay, so what that is, if you ever heard of a dirty cap table or unwieldy cap table, that means that you have several hundred of your closest friends on your cap table. Investors don't like that. They don't like to have lots and lots of people on the cap table, particularly those that are not involved with the business. So going back to the concern of when you start out, be smart, use your currency, but be smart about it. There's also issues with gaps in documentation. They can be tax issues, as we've talked about earlier. They can be simply corporate issues. They could be you don't want to promise people equity either in emails or other things and then not issue them, and then later either you have to honor those promises, or if you don't have to honor those promises, we have an issue with a buyer who may say, someone else may claim they have an ownership interest in the business. So documentation is important. I'm not just saying that because I'm a lawyer, but it is important because it can create significant problems when Larry, Moe, and Curly are selling the business for $150 million and their corporate housekeeping is not in order. You could put that transaction in jeopardy because a buyer may say, I can't trust, if you can't keep the basics straight, I might not be able to trust other things about the business. So does it typically blow up deals? No, it doesn't typically blow up deals, but it's a thing that could be watched for relatively inexpensively along the way, and cost a significant amount more when you're trying to do a transaction. Okay. IP assignments is another one, again, beyond the scope really of this conversation, but just put it on there. And then the other one is Reg D compliance. Reg D is a securities law. And essentially there's certain limitations on who you can issue equity to, generally speaking. High level, besides folks that are working with you, helping you start up the business, are your employees and the like, you want to make sure that your investors are what are called accredited investors. It's the simplest way to keep it, a simple way to make sure that you don't have securities laws issues. Even the largest companies in the world have had these issues, have had foot faults along the way. The one that comes to mind is Google. Google had issues because early on it gave out a bunch of options and didn't follow all the reporting requirements. And right when it was going to go public, it had a big issue in New York with the New York securities regulator and cost a lot of money to fix. So it's not just anybody. It's everybody, because everybody started small at one point. Okay, I think I'm out of time. So here's my contact information. I also will provide Chase with this PowerPoint presentation so you guys can look at it at your leisure. My contact information is here. Feel free to reach out to me if I didn't answer your question or if you'd like to discuss something further. And I will probably be out in Utah next, probably later in the summer, early fall. So I look forward to meeting with you at a next startup event or otherwise.